Welcome back to 15 Minutes of Finance. This is the tax plan, where I help you keep more of your money. Today's topics is all about home offices. Who can deduct them? What is the deduction you get on your taxes for them? And what are some strategies to utilize them and maximize the amount of the deduction that you can claim on your taxes this year? So let's talk about the home office deduction in general. What is it? So the home office deduction is a deduction by the IRS that allows individuals to use a specific portion of their home exclusively for business and therefore get a deduction for part of their home costs, such as rent or mortgage interest, HOA, insurance, all of the costs that go into their home. They get a certain percentage of those by having a home office. So it's an IRS rule that allows people who don't have a permanent place of business, like an office they commute to every day, to still deduct, because it is for business, the business use of that space. And a lot of people have this. I would say more than 50% of the businesses and contractors that I work with that don't have a permanent physical office separate from their home have a home office that they write off every year on their taxes. And so we're going to talk about what it looks like, legitimizing it, and if you can qualify for it. So let's address kind of who this is for right off the bat. You can probably tell this is for someone who works in some form of business capacity. So if your only income is as a W-2 employee, this is probably not the episode for you. But let me add one caveat to that. A kind of fun fact, I'll call it, that I like to talk about, and I've talked about this in multiple in-person seminars and expo workshops that I've given across the country, and that is there's no law at all preventing someone from being both an employee and a contractor of the same business. So let me break down kind of what that means. There are rules, and there are state-specific rules, and there are also IRS federal rules. So you have to look at both based on where you're domiciled, okay? But there are rules that say if you fail these tests, so to speak, that person you're hiring, they have to be an employee, and you have to withhold payroll taxes and Social Security taxes. You can't just write them checks and treat them as a contractor, okay? But there have been recent legislation that in the last, really since the Tax Cuts and Jobs Act, so for the last 7-ish years, really 6 tax years, we'll say, contractors have been in a little better place tax-wise, and oftentimes individuals will owe less taxes as a contractor than as an employee. So there is kind of this weird tie, or not tie, there's a weird conflict, let's call it, between the incentive of people working, where depending on your situation, this isn't true for everybody, but a lot of people would have more write-offs in an overall net lower tax bill by working as a contractor. The primary one that was implemented is called the QBI deduction, Qualified Business Income Deduction. And that's for S-Corps, it's for LLCs, it's also for sole proprietors working as contractors. And what that deduction is 20% of business income, self-employed or pass-through business income, is a straight deduction from your income. So you deduct that after arriving at your adjusted gross income before you calculate tax at your tax bracket. So with that new sweeping 20%, all of a sudden people as a contractor, in addition to being able to write things off like home offices, miles, meals bought when meeting clients, now they also get this 20% deduction on their total income for the year. And a lot of people have been in a more advantageous spot tax-wise working for themselves or being a contractor rather than an employee. So here's a fun fact to throw at you. Since there's nothing preventing you from being a contractor and an employee, as long as you have business functions that are legitimate contractor work and are not, I would say in the IRS wording would be in the normal job description that you currently serve as, it might be possible that where you work, there are some side jobs that they're currently paying you for that you might be able to ask them to pay you for as a contractor. The big things to look for, and there's so many rules, and because I'm not delving completely into that this episode, I don't want to say anything wrong. So I won't talk about all the specific rules. The big kind of primary categories are you would need to be free to take this same job somewhere else. So let's say you work somewhere as a receptionist, and then they say, hey, we also need like a new logo. We realize you have a really good eye for color. Would you want to design a new logo for our company? Well, if that's completely out of your usual job description as an office manager or a receptionist or, whatever your job description is, and there's no timeline. So one of the big tests is, does your boss, so to speak, control the timeline, or is it just you're paid upon completion? And do they have control over your work? If another company asked you to make a logo, would you be free to do that? If you can qualify and say yes to all of those things and pass those tests, it could be that you can be paid for certain work as a contractor. Now, all of a sudden, you're a business owner. You file Schedule C on your taxes, profit and loss from business. And now, as a contractor, you have certain costs that you would be able to deduct. So this doesn't mean you do one single job for $200 and now all of a sudden you can write off a home office and a bunch of miles, for what is really a W-2 job. But there are some people who might be able to. It's a win-win for both the employee and the employer, work as both an employee and a contractor. And then for their contractor work, that gives them some extra deductions that they can write off to offset that income. And the employer would rather pay you that share of your work, most likely as a contractor, because then they're not paying the same Social Security and other taxes. So that's going to be cheaper for them as well. But let's get back to the core of the issue, which is that for most people, this topic applies. You're probably a business owner, or you work consistently as a contractor and therefore are a business owner as a sole proprietorship. So that's mainly who qualifies for a home office deduction. Let's talk about what qualifies as a home office. So a home office, as defined by the IRS, has to be a place of work, and there's 4 tests about that place of work. So it has to be exclusively used for business, regularly used for your business. It has to be for your business. So the first is exclusive, the second is regular, the third is for your business, and the fourth is it has to either be your principal place of business, a place used regularly to meet clients and customers, or a separate structure. So if you build a separate 10 by 20 build office that you can buy on at Costco. I have a friend who did that. They built a 10 by 20 in their backyard, separate office. That for sure qualifies. That's their home office. So, and they are pretty strict about these things. So let me say that I would wager a significant amount of people who claim home office are not completely by the books with these rules. That would be my honest guess if I'm being honest with myself. The IRS, even in their kind of materials to define this, they ask this question in their pamphlet, like Office in the Home pamphlet. Does my home office still qualify if my mother uses it once a year when she comes for a visit? And the IRS's answer is no. Exclusive means exclusive. There can be no other use, even if it's just occasionally. So that's the IRS's specific legislation wording regarding home offices. So they are very strict. You can't have a bed in there. It can't be for people visiting. It has to be used exclusively and regularly for business. That's how the IRS describes it. Now, if you were audited and the photos you send to an auditor don't include a bed, could you get away with it? I don't know. That's not my job to help you commit tax avoidance. Okay. I'm a CPA. I'm not a paid on the side, under the table, sneaky consultant of yours. So I can't give that type of advice, but it's definitely an area that's often abused. And so just know that it is sort of a red flag area for the IRS for audits if you're claiming excessive home office deduction numbers that don't seem justified by your line of work. That's going to be more likely to be audited than other expense categories. So just understand that it is sort of a red flag area for the IRS. Okay, so that's what qualifies as a home office. So let's talk about methods of calculating the home office deduction. And a lot of people don't realize that there are actually 2 methods of calculating the home office deduction. Okay, so let's talk about kind of what goes into it, and then we'll talk about how to calculate it. So what the home office deduction is doing is it's getting a total cost of your home, and then you're apportioning what percentage of your home is an office, and therefore you're creating as a business expense the same percentage of your overall home expenses of all of those expenses as a business deduction. So if I rent a place and it's $3,000 a month in rent, right? $36,000 by the end of the year. And let's just use only that number. We won't talk about anything else just to make this simple. And I have a 2-bedroom. The living room is super small. I live by myself. My other bedroom, it is legitimately an exclusive home office that I do my CPA work at. 33%, a third of my home in that case is a home office. Now, that's super high. Very few homes are going to be 33%, but just to make it simple, that means I get a third of that cost of rent, and therefore I get a $12,000 home office deduction because I'm taking that $36,000 in rent and I'm multiplying it by the percentage of my total home that's dedicated to the business home office. In this case, that's 33% or 1/3. For most people, it's 20% and oftentimes much lower than that. But there's other expenses that qualify besides just rent. So the two largest categories are the actual costs of the home. So that's either rent or you own a home and then it looks a little different. So let's talk about that. Renting means it's just the cost of rent, and then you take the home office percentage. If you own a home, you do not deduct your total mortgage payment, and that's where a lot of people are confused. You don't do that. Here's how you actually claim the cost of a home office in a home that you own. You can really do, for most people, it's 3 things, depending on what state you live in. You're going to have the mortgage interest. That's deductible. So all of that interest on your home payments that you get on Form 1098 at the end of every year from your lender or your home loan carrier, your bank, that number is one of the numbers that you would multiply by that home office percentage. You would also be looking at real estate taxes. So if you have property taxes or real estate taxes, depending on what your state calls them, that also goes into the calculation. The third thing you would do, and this is kind of where at first glance, it seems lower because if a lot of that payment is principal, just the property taxes and the mortgage interest are not necessarily as much as the whole payment, and you might think that you're getting a lower deduction than someone that's renting. You also get to take what's called depreciation on the value of your home. And so this is how the IRS views that. If you buy your house for $250,000, let's say, and your home office is 20%, right? So you have a $50,000 value asset that you're depreciating. A home office, because it's a business office, according to the IRS, the depreciation rules or the life of depreciation that particular asset is subject to is the commercial real estate life. Okay, so what that is, I believe it's 37 years. So when you have commercial real estate, there's, for example, an automobile. The depreciable life of an automobile is only 5 years, okay? And the depreciable life of furnitures and fixtures like couches and stuff that you buy for your business, that's 7 years. So assets, according to the IRS, have different lives. And what that means is, let's say there's a 5-year asset that has a depreciable life of only 5 years. You buy it for $10,000. To oversimplify it, there's bonus depreciation rules, but to oversimplify it with straight line depreciation, we take $2,000 in the year we bought it, $2,000 next year, $2,000 next year, $2,000 next year, $2,000 the final year, right? It's a 5-year life asset. So we're depreciating the value of the asset over 5 years. But the IRS views your house as non-residential rental property, okay? That means commercial rental property because you're basically renting an office. And that's 39 years. I'm sorry, not 37. So the depreciable life of your office is 39 years. So in this example, you have a $50,000 home asset. You would take 1/39th of that every year. So you would get a little over $1,000 deduction every year that you have that home office up to 39 years. At that point, it would be fully depreciated and you would now have taken the full expense and you won't get an expense anymore for depreciation of that home. So that's how it works. So usually those things together, depreciation, mortgage interest, and real estate taxes, they do at least get you in the ballpark of what someone who's renting is paying. So that's how you calculate your primary category. But there's other expenses that qualify as well. So you should be calculating all of the things that go into the total home unless they are dedicated related to a specific room. So if you buy a couch for the living room, that's not a cost that gets calculated in the home office. That's a specific piece of furniture. And if you conversely get a desk that's exclusively for your home office, you wouldn't include that in your home office deduction. You would write that off as a full cost expense for your business because that's a business purchase. So, but anything else, so if you paint the whole home or you completely roof the entire home, all of those would go in towards the calculation of your home office. If you have internet, utilities, right? So your electrical bill, your water, all of those costs, they go into the full running of your house. So you're taking all of those and you're multiplying it by that home office percentage. So there's also might be HOA fees, there might be hazard insurance, there might be homeowners insurance. So there can be a lot of costs that go into your home. Get as many as you can, run them by your CPA. Most of them probably qualify unless they're for a specific room that's not the home office. It's going to be in that calculation, okay? So it can be pretty significant by the end of the year, and a home office can get you a pretty nice deduction. So when you have those numbers, how do we calculate how much is your home office? So there's two methods to actually arrive at that percentage of how much of those deductions you're able to write off towards your home office. There's the actual method, and then there's the number of rooms method. So in the actual method, it's as simple as it sounds. You measure the square footage of your home office in its actuality, the actual measurements. You compare that to the total square footage of your entire home, and that percentage is the percentage you take. So I have a 10 by 15 home office, so it's 150 square feet, and that's part of a let's make the math easy. So let's say the house is 750 square feet. Okay. I'm a CPA, but math in my head is not, it's not really my strong suit. I use a lot of Excel. All right. That's how I do good by my clients. I do not do math in my head. So if we have a 750 square foot house and our home office is 150 square feet, we're taking 20%, right? So we calculate all those things: mortgage interest, real estate taxes, homeowners insurance, HOA, utility bills, phone, internet, all of those things that go into the total house. And then we multiply by that business use percentage, which is 20%. And that gets us our home office deduction. Okay. The second method is the number of rooms method. And actually, before I jump into that also determines your depreciation percentage. So in that scenario where it's 20%, that also means the total value of your home based on what you paid for it. You would take 20% is the depreciable, what's called depreciable basis. That is the amount that you're depreciating over 39 years. It's 20% because that is the home office percentage of the home. So that's the amount that you would depreciate. So the number of rooms method, and the IRS specifies that you can only use this method if all of the rooms in your home are comparable. They don't give an exact definition of that, but just be careful. Don't be purposefully fraudulent with it, or you'll for sure fail an audit. If your office is an 8x8 room that you added on, or it's a little pocket, almost a closet in your room, and your total house is 1,500 square feet and 7 rooms in your house, they're not going to be like, oh yeah, that 8x8 room is just as big as the living room. There's 7 or 8 total rooms in your house. Just take 1/8. That's not how it works. But assuming you have a small apartment. You have 4 rooms: kitchen, living room, 2 bedrooms. All the rooms are pretty comparable. You can just take the number of rooms method. So in that case, you would take, I have 1 home office, I have 4 total rooms, I take 1/4. Okay, so you can also use that method. When calculating the number of rooms, the only 2 rooms you don't include are hallways and bathrooms. So you would include kitchen, living room, bedrooms, potentially a garage. For some people, the garage is the home office room. That's for a lot of people, actually. They convert their garage to a home office and they don't park their cars there. It's exclusively used for business. That's pretty common. So that's the 2 methods of calculating. We can either actually measure the square footage of the room. We divide by the square footage of our house and we create that percentage, or we do 1 divided by the number of total rooms in the house, keeping in mind we can only use that second method if all of the rooms in our house are comparable in size. You're most often going to see that in things like 2-bedroom apartments. But you can take whichever is larger. So as long as you're legitimately using the number of rooms method, it could be that method is a little bit higher by maybe a couple percentage points than actually measuring, and maybe it's a weird shape, so it's hard for you to measure the exact square footage. It's definitely worth exploring both options because it could be the larger percentage and therefore the larger deduction for you on your taxes. Okay, so I want to talk about one last thing in this episode, and that's we can also sort of call this segment bad or clickbait social media advice of the week. And that's something I'll try to keep covering both in terms of our short form content on Instagram under 15 minutes of finance, as well as in this podcast, as when I see viral bad advice, I'm going to try to talk about them more often. So the viral bad advice of the week is called the Augusta Rule. And I've seen a lot of random clips of, staged Instagram or TikToks of some rich person walking out of a Ferrari. And of course, someone magically happens to be there. Oh, I interview business owners. What's the number one rule that made you how much money you have? And an unbelievable a percentage of these fake videos talk about the Augusta Rule as if that's how they made $10 million. It's ridiculous. But what the Augusta Rule is a legitimate thing to consider, although what is never talked about in these viral clickbait videos is that it is in direct conflict with the home office. You cannot use the Augusta Rule if you have a home office in your home because you're already writing off a portion of your home as a business expense. But here's what the Augusta Rule says. It says you can, without declaring personal income for it, rent your house to your business up to 14 days a year at market rate. So let's say on Airbnb, your house would get $250 a night, right? You can have all your business partners over and clear out your house for a day. Again, you can't be also having your kids playing in the living room. It would need to be a legitimate effort to rent your house for business meetings, business conferences, business trainings, whatever. And then you could pay yourself $250 a day, theoretically up to 14 days a year. And you would be able to write that off as like an office rent or as a meeting space rent for your business. And you wouldn't claim it as income personally for renting out your house. Again, the maximum is 14 days. Otherwise, beyond that, now you're seen as your house as a part investment property. Okay, but 14 days is the limit, and that's for other things too. Just in general, you can rent out your house for 14 days and not declare it as income. It's not seen as actual investment income. Okay, so that's the Augusta Rule. So let's talk about when you could use it. So there are times where maybe you have a couple potential investors that you're going to meet, okay? And you're going to bring your whole team together and you're going to kind of explain what you do. You could rent your house. You can cook a meal in the kitchen for everybody. You lay food out. You rent the house for a day. You have meetings in your side room. You have desks or tables set up. That's legitimate, okay? So there are times you can use it, and if you don't have a room dedicated exclusively and regularly for business, the Augusta Rule might be the best way to get a small little tax deduction and use a space that is helpful for your business because you don't have an actual office. That's fair game. But what most people fail to consider is that you cannot use the Augusta Rule if you have a home office. And so if you work remotely and you have a room in your house that you're not really using, you should be doing a home office and make that room exclusively used for business. Because if you just do simple math, right? 14 divided by 365, okay? That's, I think, less than 4%, if my head math is correct here, once again. And so 4% is not going to be a lot of the total cost of your home. And you can't pay yourself $2,000 for a house that wouldn't rent for that. You have to be able to, under the Augusta Rule, rent your house at legitimate market rates. It can't be some shady operation where you're laundering $5,000 a night to yourself, right? You're going to fail an audit and owe a ton in penalties. So you're getting, if you think about it this way, 4% of your house's value in rent that you can write off. But if you have a home office, for most people, a home office, an entire room of their house is going to be significantly more than 4% of the total amount of their house. So being able to write off, your rent, your utilities, your internet, all of that stuff, 10% or 15% of it is almost always going to outweigh the Augusta Rule. So you often see social media clips where the Augusta Rule is pitted as this, like, here are the things the wealthy people do that the normal people don't know about. Buy my book. Like, those things are ridiculous. It is a legitimate rule. There are times where it's useful. It's almost always when you see that clickbait and a legitimate business expense that if you work in any capacity as a small business owner or as a contractor that you should be taking advantage of is the home office deduction. So hopefully I've helped you clarify, if you qualify, how do you calculate what percentage of your house is a home office and all of the expenses, or at least most of them, that you're able to list and therefore take a business percentage of. For a lot of people, this would be thousands of dollars. I'm a CPA here in San Diego, California. I work with a lot of clients here in California. I also work with clients in Virginia, in Massachusetts. I work with clients in Austin, Texas. A lot of these cities, rent is going up. So a lot of you people, you're not paying $400 in rent. You're not paying $1,200 in rent. You're paying thousands of dollars. So being able to write off even 10% by dedicating a small room in your house to exclusively business work and being able to legitimize a home office deduction, in the same way that mileage can be a very large deduction, the home office can be a huge game changer and could potentially be thousands of dollars of savings every year on your taxes. So it's a very important thing, and one that you cannot overlook if you work as a small business owner or a contractor. Thank you so much for listening to another episode of The Tax Plan, where I help you save more of your money. As always, please leave comments on the video. Please send us direct messages on what tax topics you would like to hear next, or anything that you would like me to answer in my next episode. We hope you learned a lot, and we hope you're saving money. Thanks.